oil prices are once again pushing the highs that they hit in mid-2008. There's any number of factors behind it, from OPEC quota levels to constrictions in supply towards the problems with Iran or in Libya. What Stratfor, however, sees as the single largest factor of pushing oil prices higher is simply the fact that there are more players in the market now than there were 10 years ago. Until the late 1990s, most participants in the oil future markets were what is called commercial investors. Industrial is probably a better way to think of that. Players who actually provide crude oil and take delivery of crude oil to the market. But in the late 1990s and early 2000s, a new type of investor, non-commercial investors, were able to participate in the market in large volumes. This was made possible by changes in technology, the advent of internet technology, for example, that allowed investors at a retail level to participate in the market in a different sort of way, buying and trading crude oil futures without actually ever intending on providing or taking delivery of the product. The advent of internet technology took this to a completely new level, allowing a new magnitude of investors to participate. These technological changes occurred at the same time that the baby boomers matured. Mature workers are preparing for retirement. The kids have gone, college is paid for, the house is probably paid for, and so they're socking away their money for retirement. A lot of that money has made it into various energy funds, artificially increasing the demand for those products. The difference between the year 2000 and the year 2011 couldn't be more stark. Right now, non-commercial investors, or what we just think of as investors, now make up for 40% of long positions in the market. 40% increase in participation in a market that's as inelastic as crude oil is going to send prices higher. Now, this isn't the only factor, and it doesn't rule every day, but it does provide a structural support for the market that didn't exist there. Now, what these people are not is speculators. Speculators are people who are specifically betting on the price of oil and perhaps even trying to force it in a particular direction. These are the people that the Obama administration is not particularly fond of. This is a completely different phenomena from what we're seeing as the secular shift in energy prices over the last decade. Now, what this mass of new investors does is provides a huge amount of liquidity and income support for anyone who wants to invest in crude. They're providing the basis, actually, for increasing supply in the long run. There's, however, several side effects. One, of course, is higher prices. Another one is that they are often betting in opposition to what fundamental trends are doing. So, for example, if you have a situation where prices are rising, industrial consumers of crude are doing everything they can to cut demand. They want to limit their exposure. Not so for investors. They see prices rising, they want to jump on that bandwagon. And so you get these weird moves in the market, often with prices swinging wildly from extreme to extreme. The most dramatic impact, of course, is when the fundamentals ultimately do win at the end of the day. This happened in mid-2008 when prices were $140 a barrel. Industrial consumers simply couldn't support that kind of price level, and the world was tipping into recession on a global scale. But investors were still pushing the price up, and when they realized that the fundamentals were correcting everything sharply to the downside, their mass removal from the market led to a price collapse of roughly 3/4 of value. But there's an additional factor that is actually making all of the waters even murkier. Over the course of the last 6 years, global money supply has roughly doubled in size. When you have all four of the major currency blocks increasing their currency by such a huge volume collectively, that money's going to go somewhere. So we've seen a huge amount of capital from this monetary expansion move into commodities of all sorts, and first and foremost, oil. There's no indication at present that authorities in any of the four major currency blocks are going to take appreciable moves to restrict investment into commodities in the near future. In fact, that would probably be detrimental to the efficient functioning of the markets. But the investors are having an impact. Prices are volatile. They do move sharply up as well as very sharply down. And this is going to remain the state of affairs at least as long as this monetary expansion is in progress.